The door's just locked. JPMorgan Chase, the largest bank in the United States, just implemented what they're calling temporary liquidity restrictions on customer accounts. Translation? Your money is frozen. 0% access. And if you think this is about protecting you, you haven't been paying attention to how this game works. Right now, as I'm recording this, customers across 17 states are reporting they cannot withdraw more than $200 per day from their accounts. ATMs are displaying error codes. Wire transfers are being rejected. And the official statement from JP Morgan? Routine system maintenance. Routine. That's the word they used. Nothing about this is routine when you're holding $900 billion in customer deposits and suddenly those customers can't access their own money.
Let me walk you through what's actually happening here, because the mainstream financial media is going to spin this as a technical glitch. They're going to tell you it's a cybersecurity precaution. They're going to say your funds are safe and this will be resolved in 48 hours. I'm telling you right now, this is not a glitch. This is a stress test, and you are the lab rat. 3 weeks ago, JP Morgan's derivatives book showed exposure to interest rate swaps totaling $47 trillion. Not billion, trillion. That's more than twice the entire GDP of the United States sitting on their balance sheet as hedged positions. When Silicon Valley Bank collapsed last year, their derivatives exposure was a fraction of that, and we saw how fast 17 billion in deposits evaporated. Now scale that up, way up, and ask yourself what happens when the largest bank in America starts showing cracks.
But here's where it gets darker. This freeze didn't happen in isolation. 2 days before JP Morgan locked down withdrawals, the Federal Reserve quietly amended emergency lending guidelines for primary dealers. Primary dealers are the banks that are allowed to transact directly with the Fed. JP Morgan is the biggest one. The amendment. It expanded the collateral requirements and loosened the standards for what the Fed will accept in exchange for liquidity. Why would they do that unless someone was about to come knocking desperate for cash?
Connect the dots. The Fed changes the rules. 48 hours later, the biggest bank in the country freezes customer access. And in between those two events, we saw a massive spike in overnight repo rates, jumping from 5.3% to 6.9% in a single session. The overnight repo market is where banks go to borrow cash when they're short. When that rate spikes, it means someone is scrambling. It means the plumbing is breaking.
Now let me take you inside the mechanics of what a bank freeze actually means for you. When JP Morgan says you have temporary restricted access, what they're really saying is that your account balance is a number on a screen, and that number is not backed by actual cash sitting in a vault. It's backed by loans, mortgages, corporate debt, derivatives, all of it illiquid, all of it vulnerable. The moment too many people try to pull their money at once, the whole structure collapses. That's called a bank run, and the only way to stop a bank run is to lock the doors.
This is not speculation. This is how fractional reserve banking works. JP Morgan is required to hold only 10% of customer deposits in actual reserves. The other 90%? Loaned out, invested, leveraged. So when you have 900 billion in deposits and only 90 billion in reserves, you can handle normal daily withdrawal volumes. But the second there's panic, the second confidence cracks, you don't have the cash to meet demand. And that's when you freeze accounts.
What triggered this? I've been monitoring the bond market, and what I'm seeing is a dislocation between treasury yields and the actual availability of physical treasuries to settle trades. 2 weeks ago, we saw failed treasury auctions where primary dealers refused to bid at the yields the government was offering. That's unprecedented. It means the biggest banks in the world looked at U.S. government debt and said, not at that price. When that happens, liquidity dries up. And when liquidity dries up, banks get desperate.
But here's the part they're not telling you on CNBC. While JP Morgan is freezing retail customer accounts, their institutional clients, the hedge funds, the sovereign wealth funds, the billionaires, they still have full access. I've confirmed this through 3 separate sources inside the wealth management division. High net worth accounts are moving money freely. It's only the regular customers, the middle class, the small business owners, who are locked out. This is not a system-wide failure. This is selective enforcement, and that tells you everything you need to know about who this system is designed to protect.
Now let's talk about what happens next, because this is where it gets geopolitical. JP Morgan has massive exposure to European banks through cross-currency swaps and credit default swaps. Over the last 6 months, Deutsche Bank,
Credit Suisse's remnants inside UBS and Societe Generale have all seen their credit default swap spreads blow out. That means the cost to insure against their default has skyrocketed. Why? Because they're sitting on hundreds of billions in bad commercial real estate loans and exposure to Eastern European debt that's going to zero. When those European banks start to fail, and they will, the contagion hits JPMorgan instantly. Not because of direct loans, but because of derivatives. JPMorgan wrote the insurance, they sold the swaps. And when the counterparty defaults, JPMorgan is on the hook. That's the systemic risk nobody wants to talk about. One failure triggers a cascade, and suddenly the largest bank in America is insolvent.
And here's the kicker. While this is happening, physical gold just hit $2,900 per ounce in Shanghai. Not on the Comex, not in the paper futures market. In China, where you can actually take delivery of metal, the price is $230 higher than what you see on your screen in New York. That spread, that dislocation, that's the market screaming that the paper price is a lie. The real price of gold, the price that reflects actual supply and demand for physical metal, is being set in Asia. Not in New York, not in London, in Shanghai. And it's rising fast.
Why does that matter? Because JPMorgan is the largest holder of short positions in the gold and silver futures markets. They've been suppressing the price for years through naked short selling on the Comex. But when physical demand overwhelms paper supply, when people stop trusting the contracts and start demanding metal, those short positions become a ticking time bomb. And if gold keeps rallying in Shanghai while JPMorgan is stuck short on the Comex, they're going to face a margin call they cannot meet. This is the smoking gun. This is why they froze accounts. They need to preserve liquidity because they know what's coming. They know the derivatives are about to unwind. They know the physical market is about to expose the paper market as a fraud, and they're buying time.
But time is running out. Because while JPMorgan is playing defense, the BRICS nations just announced they're expanding their gold-backed trade settlement system. Russia, China, India, Brazil, South Africa, and now Saudi Arabia, UAE, and Iran are all moving away from the dollar. They're settling oil trades in yuan, they're buying gold, and every ounce of gold that moves east is one less ounce available to settle contracts in the west. The great physical squeeze is underway, and JPMorgan is caught on the wrong side.
Let me paint you the worst-case scenario, because this is what keeps me up at night. If JPMorgan cannot meet withdrawal demands and the Fed has to step in with an emergency bailout, we're looking at a replay of 2008, but exponentially worse. The Fed will print trillions. They'll call it quantitative easing or emergency liquidity provisions. But what it really means is your dollars are being debased in real time. The money you have in the bank, if you can even access it, will buy less. Inflation will spike. And the wealth transfer from the middle class to the asset-holding elite will accelerate.
And don't think your deposits are safe just because of FDIC insurance. The FDIC has $125 billion in its insurance fund. JPMorgan alone holds $900 billion in deposits. Do the math. If JPMorgan fails, the FDIC is insolvent instantly. They'll have to go to Congress for a bailout. Congress will print the money, and your savings will be diluted into oblivion. This is not fear-mongering. This is pattern recognition. We've seen this before. In Cyprus in 2013, they froze accounts and then imposed a bail-in, confiscating depositor funds to recapitalize the banks. In Greece in 2015, they imposed capital controls, limiting withdrawals to €60 per day. In Lebanon in 2019, they froze accounts entirely, and people lost access to their life savings for years. It has happened. It is happening. And it will happen here if we don't wake up.
So what do you do? First, understand that your bank account is not a safe. It's a liability on the bank's balance sheet. The moment you deposit money, it's no longer yours. It's the bank's. You become an unsecured creditor. And in a crisis, unsecured creditors get wiped out. That's the legal reality. Second, diversify your counterparty risk. Do not keep all your money in one institution. Spread it across multiple banks, credit unions, and hold physical assets outside the banking system. Gold, silver, cash in a safe. These are not investments. These are insurance policies against systemic failure. Third, monitor the signals. Watch the repo rates. Watch the Fed's balance sheet. Watch the gold price in Shanghai versus New York. These are your early warning indicators.
when the spread widens, when the Fed starts expanding its balance sheet again, when repo rates spike, that's your signal to move fast.
And fourth, understand that this is not just about JP Morgan. This is about a system that is built on leverage, fraud, and the assumption that you will never ask for your money all at once. The moment that assumption breaks, the whole thing collapses, and they will do everything in their power to prevent you from pulling your money before they do. Right now, tonight, there are people inside JP Morgan who know exactly how bad this is. There are risk managers running stress tests. There are lawyers drafting emergency filings. There are executives on calls with the Fed, the Treasury, and the White House. And none of them are going to tell you the truth until it's too late. By the time you see the headlines, by the time the press conferences happen, by the time they admit there's a problem, the exits will be locked and your money will be trapped.
This is the reality of modern banking. You are not a customer. You are a source of liquidity, and when they need that liquidity to cover their bad bets, they will take it. They will freeze your account. They will impose capital controls. They will bail themselves in with your deposits, and they will tell you it's for your own protection. I've been tracking this system for 2 decades. I've watched the leverage grow. I've watched the derivatives balloon. I've watched the central banks paint themselves into a corner with 0 interest rates and infinite money printing. And now we're at the end game. The piper must be paid, and the bill is coming due. JP Morgan freezing withdrawals is not an isolated incident. It's a symptom of a much larger disease. The entire banking system is overleveraged, undercapitalized, and dependent on confidence. The moment confidence breaks, the system breaks. And confidence is breaking right now.
Watch what happens over the next 72 hours. Watch for more banks to announce technical issues or maintenance windows. Watch for limits on wire transfers. Watch for delays in check clearing. These are all signs of liquidity stress. And liquidity stress is the precursor to collapse. The paper market is dying. The physical market is taking over. And the banks that bet against reality are about to pay the price. Your job is to make sure you're not holding the bag when they do. 3 key takeaways and we're out. 1. Your deposits are not safe just because they're insured. The FDIC does not have enough money to cover a JP Morgan failure. In a systemic crisis, insurance becomes meaningless because the insurer itself goes bankrupt. Diversify your counterparty risk and hold assets outside the banking system.
2. This freeze is a symptom of derivatives exposure and liquidity stress. JP Morgan's $47 trillion derivatives book is the real risk. When counterparties start defaulting, those positions unwind fast and liquidity evaporates. The freeze is them buying time before the cascade begins. 3. The physical gold market in Shanghai is showing you the real price. The $230 premium over New York is the market telling you the paper price is manipulated. When that spread collapses, when physical delivery is demanded on the Comex, the banks short gold are finished. Position accordingly. Stay safe, stay liquid, and verify everything.